Helene, thank you again so much for agreeing to be part of our discussion as we work on this values and lifestyle-based banking report for the Emerging Payments Association and the Inclusion Project. So firstly, would you mind telling us a bit more about yourself and your experience to date?
It's lovely to be here, and this is an area that really matters to me, and it should matter to all of us at this point. I entered banking a very long time ago as a correspondent banker covering the German-speaking countries, the DACH region. Never a place I intended to get into, banking, she says, but once I got in there, I realized that it was something that fascinated me and that I wanted to make part of my life, but not as a banker. So all of my career journey has been involved in something to do with finance, whether I'm helping people raise finance, and that would have been over 20,000 companies at this point, or working with fintechs, creating fintech scale programs, setting education and event programs, for example, for the trade body, creating the rainmaking fintech scale program for tier ones, and lecturing at 3 universities in fintech in various ways, whether it's a master's or exec ed. But along the way, what started to become really important to me was also that relationship between fintechs and financial institutions. For years, I think I was banging my head against the wall of the tier ones, and love them as I do. There are other banks out there in the smaller banks, and I tend to focus a lot of my attention now on community banks or smaller tier 2 and tier 3 banks, or building societies here. But I'm also very passionate about the SME. So if you're a smaller bank that can help an SME as a community, or a bank that can help a community that is a clearly geographically marked community, or a community of affinity, that's where I personally want to be helping people now. And obviously, as I've gone on, I've written a couple of books. One was around the funding and those 20,000 plus companies on the funding journey. And then more recently, Reinventing Banking and Finance, where we take a historical view back to Genoa in the 13th century and hyper-personalization in banking through to digital banking and hyper-personalization at scale.
Incredible, Helene. Thank you so much. And I guess there's something that you raised, which of course is highly relevant to why we are talking, which is your focus on community banks, your focus on smaller, maybe regionally focused banks. And of course, part of this report is how we do lifestyle and value-based banking in the context of enhancing financial inclusion. And I wonder whether you might be able to speak a bit more about your work, maybe directly in the context of financial inclusion, and what has that looked like, and maybe a sense of how you've seen financial inclusion as a theme emerge over fintech in particular, but also generally more within the banking space.
It's interesting. When we talk about financial inclusion, financial services, most of the time we're referring to the 2 billion unbanked, underbanked people around the world. And the assumption is that it's people that don't have access to any financial services. But for me, it goes wider than that. It goes to people that have been underserved. And the SMEs, obviously, stroke SMBs, have been underserved traditionally, be that because they're a fragmented group of consumers deemed to be higher risk, without much of a reward or a return, no secondary market. And so everyone kind of shied away from them until alternative finance providers stepped up. Or is that a group that is a faith-based needs in a financial situation, and everyone just thinks, well, they're over in that geography and a part of the world. It's not really relevant to me, and I don't really need to understand where they're coming from and their principles are, because they don't carry over or they won't commute to my part of the world, which is wrong. And then also in one of the roles that I have with Calgera being an organization that was set up by a doctor who works with dementia patients at UCH, Dr. Dexter Penn, realizing that people were being scammed, and that spun itself out to a broader group of people that are deemed to be vulnerable in terms of financial services. And of course, at the end of this year that we've had, the FCA and other regulators are now looking at vulnerability, resiliency, how we as financial services deal with people who are vulnerable. And another group that needs to be included. Now, we looked at people with dementia, carers, and then other people with other mental health issues. But that's going to touch so many of us. I can remember the financial crisis of 2007, 2008, when we were not so caring and not so kind and not interested in what happened to people. And many people lost their businesses, their homes, and sometimes their lives. So it's good to see that we've changed, but there's much to be done. So I see this in a variety of ways. I was also fortunate enough to spend some time working in Dubai on a project at the DIFC Hive, and I got to dig a bit deeper into Islamic finance and Islamic fintech. And of course, we saw it in the UK with property platforms as the first foray into this space because there's an asset and so it makes sense. But when you speak to people about the 1.8 billion population size of the community and the fact that it's not all centered in the GCC, and you sort of look at people and think, wow, you haven't really thought about the whole world and why this matters to people. But the principles behind it, and I don't profess to be an expert, just make good sense, right? Is there a need to charge somebody 1,749% interest on something? I think not. You know, there are other ways to take into account risk and credit history and to package it up differently. So we need to start thinking differently.
Helen, I could not agree with you more. And I really want to unpack that. And I'll come back to this idea of how can we be inspired more by some of these principles which have been on the fringes, which might benefit the mainstream. But I think in your book, your most latest book, Reinventing Banking and Finance, I think you look at the past, the present, and the future of the industry in the context of conventional approaches, innovation and technology. What would be really interesting is perhaps to get a sense from you about maybe with a more historical lens of how lifestyle and values are changing the industry. And when did that really come about from your experience, and how has it always been part of the equation, and have we moved away from it and we're coming back to it? Or is this a more recent phenomenon? I'd love to get a sense from you of your own experiences on that.
Interesting, because we of course we in fintech, and fintech wasn't even a word or around, obviously, until about 2011, 2012, and we could debate about who coined that. It's a bit like saying with Satoshi, really, right? Everyone's laying claim to that. The technology of the day was always serving the financial needs of the community. That is fintech for me as a definition. But this change was, and a big part of the change came in 2007 with the advent of the smartphone, and of course the millennial generation, where the shift went from inside out in banking to outside in. And then suddenly the customer-centric approach, the customer drive, I want something for me. And I'm seeing you, bank, as a utility, more usage, more than I am as a place for my loyalty. So you need to actually give me what I need. And of course, the banks have been sitting on the data for a long time, but not using the data or doing something with the data, interrogating it, extracting insights from it to be able to then package up something that is specifically for me, until a generation came along saying, hey, we don't care if you've been around 350 years. What we care about is what we want, and now you need to change. So we're seeing it in modern times, and we understand it in fintech. But if we think back, very back to Genoa, as I said, and to the Medici and all the historical side in Italy, there was one banker and one family or one state that it was serving, and we were in extreme hyper-personalization because it was a one-to-one relationship. As we move forward in terms of history, we get into the industrial bank and the industrial revolution, which was a very marked moment of trying to take something that was individual in its focus and make it suitable for the mass. Think of the whole Victorian era. It was all about mass production, mass access to things, right? The Victorians were great at inventing things, at processes, and getting it out to many more people. So then you lose the personalization when you go to that mass market, right? Everyone had the same bottle. Everyone had the same everything at the time, you know? And if we move forward from the industrial bank and the industrial revolution into the IT bank, so we're moving, rapidly forward. And in the 1950s, for example, in the 1960s, yes, technology was an enabler for the bank. It made it more efficient for the bank, but it also took me, the customer, further away from my relationship manager, further away from my branch, further away from getting what I wanted in a personalized way, but was more efficient internally. And then we start to see banks really pricing things up, creating products with margins and targets, saying to the consumer, hey, here's the thing, take it or leave it. We're not going to personalize it for you. And I don't really care who you are. It's just what it is. And because we saw a contraction, for example, in the UK from 1960 to 2010 of what would have been 150 banks, whether that was consolidation, acquisition, closure, from 150 down to 6 banks having the majority of all of our accounts in our business, there really wasn't any incentive to do anything differently, right? Or to switch banks. There's a question of inertia, but also what was the point of going to switch because you were getting the same products from everybody until the smartphone and the digital bank. And that was only 2007 that the smartphone launched. And we didn't need to build a monolithic structure with heavy siloed physical bricks and mortar locations. We could do it on a marketplace platform in Java Plus and bring the cost down and use technology as an enabler. And then we also have now the use of APIs, and we move on to open banking where I can share my data. So suddenly there's a data exchange on the pipes. I'm able to say to you, hey, I'm going to share my data, but in return, me as a business owner or me as an individual, I want you to push back a product that's exactly what I want. Why should I pay 15% when I'm actually a 4% loan? But you've not lumped me into the category anymore, and I don't accept that anymore. So there was a little bit of, obviously, the Competition and Markets Authority saying, hey, this is not a competitive environment. We had an attempt on the business side of the bank referral scheme, which didn't really work very well. And then on that, wet Saturday afternoon in January in 2018, open banking launched onto the scene. And suddenly we understand that we're in control of our data, which we gave away freely before that as consumers. And we can use that to actually get products and services that meet our individual needs. So we've kind of got hyper-personalization at scale, enabled by digital technology, supported and by regulation, of course. And now we're moving on to a bit of an education platform to show people how to use it, because we've got 3 million users of open banking, for example, in the UK, but we could be getting to many more if we get out with more than just the features and benefits.
It's almost as if you lecture about this, Helene.
I was thinking that was a very long explanation.
No, I tell you, it's absolutely fascinating, especially the historical piece, from the personalization to the industrial, to the technological, to then shifting. And for me, what's really fascinating about what you described is, of course, the relationship between an individual consumer and a merchant or a bank, or a bank even, and how that went further away and then has been brought together by technology. And I think that's incredibly interesting. Do you think the trend, is this trend global? What's, in terms of that journey that you've just described, which I think is really well articulated, how advanced is that journey in different parts of the world? Because it sounds like quite, I think there are particular spaces and jurisdictions which are more advanced. Could you maybe give us a bit more of a global sense of that picture, especially the bit between that individual relationship through to the mass relationship, through to, that separation, that distancing away from consumer to product, and now that's edging back again. But is that edging back again happening in all parts of the world or some?
It's interesting because some parts of the world, like the Middle East, or let's say some parts of China, didn't have the legacy systems, didn't have the silo systems. I hold my hand up. When I was in the early 80s and 90s, or to the early 90s, I hired a lot of COBOL programmers and sent them all around the world. And all these rooms full of IBM AS400s that are supporting the banking system, the incumbent banking system, are full of COBOL programmers from the language that was born in 1969. And now there are a few people that can work with it. But we're in a unique situation there where we have a very old infrastructure that we're still supporting, and that's why it's so expensive when you have a bricks and mortar infrastructure. But there are lots of parts of the world that don't have that. Africa doesn't have these, a lot of it doesn't have heavy incumbent systems, legacy systems. MENA doesn't, a lot of that didn't have these heavy COBOL systems. So they could move more easily into a digital infrastructure, and also one that's enabled by the phone. Now there's a question of smartphone, dumb phone, if you know what I mean. You need a smartphone to do a lot of these things. And that can be a hindrance in places, but it is beginning to change. So I think some of the geography has to do with what happened and what came in those locations before that. Now, if I look, for example, at the US, where we do have the heavy legacy systems, more slowly we're coming into the digital world. And I can remember maybe 2018 being in the US, talking to someone from the Commerce Department there in Washington, asking me about the neobanks and digital banks from the UK and from Germany that were coming into the US and whether or not the US would be able to respond. And of course, then we have Chime that is part of the response. Varo is part of the response. Of course, they could. Now, bearing in mind, they have 35 regulators where we have the FCA and the PRA attached to the Bank of England. It's a much slimmer system. Singapore, MAS, BaFin in Germany, depending on where you are, the regulatory environment can also facilitate that this digital and therefore being able to be more personalized can come more easily. Now, having said that, I think the last year has shown us that it's not only the large banks that are launching digital propositions, but the smaller banks that are having to accelerate their digital transformation are there to be able to service different communities, be they farmers or small businesses, or the LGBTQ community, or the Islamic faith community, or the construction industry. So more and more, and also this is alongside as we get more banking licenses, we've had virtual licenses issued in Hong Kong. I understand there's going to be a new banking license issued in Turkey. We've had many licenses issued here that are still coming. And now in the US, we're seeing some national charters come out. It takes longer, to get to one, maybe it takes about 3 years, but we're getting more of these licenses. Suddenly, we're seeing people say, you know what, I could service a particular part of the community. And I may be a community provider who already had this group in my 100-year history, but I need to use digital technology to actually get there in a much more user-friendly way. COVID, of course, meant that I couldn't go to the branch. I couldn't go speak to somebody. So if you were on the digital back foot, you really had to step up your game. And for example, in the US, the first $9 billion of the stimulus package went to people through the community banks in the Midwest. So they definitely did step up in that space. We saw the launch of Daylight, the LGBTQ bank, which has two banks behind it as bank of records, one in Kansas City and one in LA, but was built on a banking platform and therefore can provide products and services that are specific to the LGBTQ community, who have been traditionally underserved, although, for example, in the US as a market size, it's 30 million people who identify as LGBTQ. So it's a large, it's all of Barclays as a customer base, right? The 350 years of Barclays. And areas, it's not just about getting another loan or getting another credit card. It's what matters to these individual communities. Is it that you need more wealth creation? Is it that you need more financial education, which we've also seen with the launch of the Boulevard, which started out as 10th Bank in the US for the African-American community, of course, fueled by Black Lives Matter. But then you have a clear understanding that in many Black households or African-American households, there wasn't financial education at home and there wasn't the same level of education in school. I heard or read a statistic that really jarred with me, that $1 goes into a bank account in the US. If you're, say, a white middle class consumer in your bank account, it stays there for 17 days. In an African-American bank account, it stayed for 6 seconds.
Wow.
It went in, it went in and it paid bills. It went in and it went out, right? So how do you then accumulate wealth? How can you then plan your savings? How can you then, if you want to get on the property ladder, do that if the money's not even staying in your account for an hour?
Now, in terms of views coming out of particular community groups, should banks change their behavior and their product offer based on their consumers? In fact, not should, do they? I'd love to hear your views on should they, do they, right? Or should they change consumer behavior, right? And the two examples I'll give, of course, we talked about, whether it's the LGBTQ plus community and wanting a particular type of product, whether it's those who have faith-based banking and want particular products. Or I'm just thinking from a corporate ESG perspective, the environment and climate change is the single biggest issue affecting humanity, right? So how and in what way should these things play out in your opinion, and how do they play out also?
It's interesting. Again, it's a good point to remember that it's called financial services because it's a services industry. And we serve the consumer, or we serve the customer. So I definitely think banks should be serving their customers, and they should be doing it in a way that they want to be served. So I wouldn't, I would go on the side of the bank changing their behavior versus the consumer changing their behavior. Of course, consumers, if they want to be helped to change their behavior, to save more, to invest more, to understand what they're getting involved with. That's all welcome if that's what they want. But that is the essence of it, is that we are there to serve as financial services, to serve our customer. So I think it has to go in that direction. And, you know, we think about different communities. For example, in the Middle East, we know that there's a very, in Dubai, it's predominantly Indian and Filipinos who are working in Dubai, and a very small Emirati population. So money's going back to the Philippines in terms of remittances, for example. So how does the banking system, and remittances is something like a $50 billion market in the Middle East. There's enough there for everyone to make their money and make their revenue and make their profit, but also to serve their community well. Because if you're not giving people what they want, they have an option now. They have an option to go to a fintech. So how do you hold on to people? And this kind of, you know, if we look at the model of WeChat or WeChat Pay or the super app, we're at this moment where incumbent banking didn't work very well. We had the advent of the smartphone. We were able to create digital banking, and therefore to create propositions that put me as the consumer in the driver's seat, and I have 24/7 access, and the model shifts from inside out to outside in. Now moving forward, because we have the technology to be able to create a platform where I can plug in through APIs and work with different providers, what is to stop me in 2 years' time sitting there going, hey, bank, you're in the background. That's great. You've got the license. You protect everything. We're all insured. But actually, what I want from you is to give me the best loan that's on the market, not necessarily the one that you offer. Or what I want you to curate a marketplace of all the things that I want. And I want to be able to also get some loyalty points or get some cash back and speak to other people in my industry that bank with you. So the consumer, again, is saying to the banks, I want the kind of super app, which PayPal and other big tech is now stepping up and saying, hey, we can do that for you. Right? You don't necessarily need to go to a bank. We'll partner with the banks as big tech, Googleplex, Plus, PayPal, Facebook. We already have your data. We have your trust. We have the usage. So let us take the partnership with the bank. And you, the consumer, can actually sit there and go, I want one from here, and one from there, and one from there, right? And make your own bank. And Monzo had a little bit of a go at this a few years ago, but I think that might have been a bit early for consumers to understand.
So Helene, can I sorry to interrupt you? Can I ask, so where do you think, just in terms of what you've described, and by the way, I do agree with you. I mean, it's interesting. I think there's an interesting tension here between services you serve, right? You serve the needs of people, but then also, you know, in terms of responsibility, if we serve based on existing conditions that we've been socialized into, then how do you also disrupt a system which might be causing climate change, for example, as a point of philosophy for us to consider? But that's not the point here, which was around if you're responding to consumers and it's being done really well, where do you think, where are some of the most advanced systems in terms of financial systems in the world where what you just described, where maybe values or lifestyle banking happens the best in the world? Where do you think those places are?
Where it's happening the best. I mean, weirdly, you know, from if people would think, well, it's definitely going to be here because we have the FCA, we've got a very digitally adept population, we're on top of it all. I actually think these things are happening in emerging markets much more easily because the tech is enabling them, and because they don't have all the history and the legacy behind them, right? So you might see things coming out of Africa and out of MENA before you'll see them coming out here, or for example in the US or Canada. Where we're still struggling with the history and the legacy systems. Now on ESG, the regulators will mandate, and of course every bank now feels responsible, but bearing in mind also your future client base is a millennial and a Gen Z who care about these things in an active way. If you want to keep these customers and get these customers, you need to respond to them. As a baby boomer, we had different things that mattered to us. And if we look at the world of, say, robo-advising and wealth, everyone feels that the next, the money is going to be in the hands of women and of millennials and Gen Z. And apparently, these are three groups that care more about our planet and where we're going. And so they will force it. They'll force the investment to happen that way, and they'll force banking to respond that way. And the regulators will then make it a regulation, which might start out as a standard, and then everybody will have to do it. I mean, ultimately, it will be good for everyone. It will be good for the bottom line because you're giving your customers what they want. But there would have been a bit of a friction and a transition there, maybe 2 years ago, when people started to talk about it and they were on the fringes about this type of investing, for example. I can remember having conversations with fund managers saying, yeah, we'll get to it when we have to. But now it's in full swing, right? And
fascinating.
That's the thing.
Fascinating how that happens. And it's, also really interesting that you hear about that you mentioned Gen Z and the millennials and the younger millennials. Do you think financial institutions, I think the new ones coming through obviously are looking to disrupt, and they tend to go for a younger demographic. Do you think older financial institutions or more traditional financial institutions are doing enough to future-proof themselves on this agenda?
I think they've started. So no, they're not doing enough right now. And I think that also speaks to like, what is the size of the organization, right? If you're a well-stacked cash rich or, asset rich incumbent, and you have lots of people as well that you can spin it out and try it out. Or you can try out a digital bank. You can try out a student bank. You can try out a gig worker bank. And if it doesn't work, you just shut it down. You can spend billions on that and it's not too much of a hit. If you're a smaller bank and you're trying to do this, you have to be more considerate about it, because it could be the beginning or the end of you, depending on how much money you're spending on it. And also, let's face it, everyone has an agenda, right? So if you're leading one of these organizations, it could be the beginning and end of your career as well. So you really want to think, about that. But so we're at varying stages of maturity in terms of digital transformation and acceleration. COVID absolutely just rocketed everybody up, exponentially, sure. And we have to remember also that most banks have some contractual obligation with a core provider. And if your core provider, say you're in that situation for 5 or 10 years, isn't working with fintech solutions or doesn't have an overlay platform where you can plug in a fintech solution, it's harder to then give something very quickly to the market for that it wants. So it's a bit of a very fluid situation right now. I think everyone has accepted that the front end needs to be better, the old lipstick on a pig. But the middle and the back office can also gain efficiency and therefore provide a better service to their end user, or a better product to their end user, by partnering with fintech. And I think partnerships and collaboration is the thing that will enable people to do that. Can we do it fast enough? Questionably. Some people will go to the wall. Some banks will consolidate. Some will merge, for sure. Some big tech will step in and start taking some market share, absolutely. And some fintech on its own. We had a moment where people were using more apps than they were using banking solutions. We'll be slightly getting away from that because that unbundling was a bit clunky. Now we're rebundling that, but we're rebundling it in a different way, potentially with a platform with a bank of record behind it, using APIs and the access that I give you to my data. And that happened in a very short space of time. One thing about this, about fintech and about banking as it is now, where we are now will not be where we are in 2 years.
Helene, thank you so much for your time. That was wonderful to hear your insights, and we hope to continue the conversation further.
Thank you very much for having me and for doing what you're doing. Very important.